Bonds. Good old bonds. The Treasury curve. The shapes that have taken in munis and in taxable for the last few years are breathtaking if you're a bond person. Let's talk about it.
Yeah, I mean, just to state the obvious, right? Rates rallied across the curve this year. The curve did steepen, which is very typical during a Fed rate cutting cycle. I want to just get investors excited about three things, right? Number one, if you look at the backdrop that Eric painted, growth around trend, inflation stable to coming down, just about two cuts priced, just a little over two cuts priced in for the Fed, right? Yields should move lower, right? I think we're setting ourselves up for what will be a very good environment for fixed income. Second, look at the blue curve, right? And this is, touching the third rail of talking about, roll and carry, right? But this is something my friend Matt Norton in the muni market has been enjoying for the past couple of years. But you can see the curve is steep now. And right, in simple, what is roll? You buy a 7-year bond, for example, at 393. 1 year from now, that's a 6-year bond to maturity. It trades at 372, right? And you just capture, right, that lower yield and that price move, which is about $1.25. Right? So just having that steep curve improves your chances of generating positive returns in both the taxable and the muni market. And I would just say third, right, we have to think about cash, right? There's still $7 trillion in cash, right, sitting in money markets. You have inflation running just below 3. 6-month T-bills are trading around 345. Right? So if you're in cash, you're getting very little real return. And if we're right on the Fed, you'll get less and less as you go. Right? So again, we think the impetus is there for people to continue to move money into the fixed income markets. So,
I was going to say there's a global theme at play. And so this is my old roots, my old home on the fixed income team and global fixed income. We get to talk about global bonds.
Yeah, I can't let Nelson steal all the international thunder here, right? And look, we talk to probably one client a week who is worried about the U.S. debt burden, who is worried about the fiscal spending that will occur in 26 or potentially occur in the future. And they are looking for ways to think about getting out of just having U.S. duration, right? So for us, what we show on the left is our, Rick's favorite hedged yield chart. So if you just look at sovereign bonds across 8 or 9 different countries there, and you take out the currency risk, what kind of yield do you get as a U.S. investor? And you can see, if anything, the U.S. is actually the lowest yielding, right, market out there. And if you go to the right, you actually see those yield curves hedged. And maybe surprising to some, right, you buy long end JGBs, right, Japan, you're getting about 6.5% yield, right, without taking that currency risk. So there is an enormous potential for investors to move some of that treasury exposure, some of that ag exposure outside of the U.S. into some other opportunities.
It's a bit of a wonky thing for those that don't live in sort of the global bond or the hedge currency world. But the idea is when you're hedging from, say, the yen and a JGB, a Japanese government bond, back to the dollar, the differential between the rates can cause your realized yield, even though you've removed the currency risk away, to actually climb. And that's something we've talked about forever. And this is really live right now across a lot of countries.
Yeah, and it's just simple currency forwards. You can get the rates in the Wall Street Journal every day, right? There's nothing exotic about these structures.
How many people that don't work in fixed income go to that part of the Wall Street Journal every day that you know? Let's talk about that. So this is your riff slide. This is a lot of the different sectors. The theme is spreads are tight in a lot of places, but yields are still relatively attractive.
Yeah, we keep kind of harping upon the point that spreads are on the left. And if you look at the purple, right, that's where we are today. And across most asset classes, we are towards the lows. However, when you go to the right, yield is what matters. Yield is what's a good predictor of future returns. You see in many cases, we're right around median, right? One of the more attractive data points on here is emerging markets, right, to us that, is coming in above 7%. So despite having those lower spreads, the all-in yield still looks fairly attractive.
And then specifically on high yield, we've shown this chart over and over and over again, but it's the same idea. Spreads are tight, yields are high because treasury yields are elevated on a relative basis. And forgive me for everyone that's been joining us for years and seeing this chart over and over again, but your starting yield to worst is incredibly predictive of your forward. Even as crazy as COVID was, we added a new bar here on COVID. even as crazy as it was, the lack of liquidity, the behavior of credit out of the gate, how long it took to get going again, you still, over a 5-year span, are awfully close to where you started with the yield.
Yeah, and Rick, I think that tells the story, right? We've been, pounding the table on a high yield for the last several years. The credit quality is still incredibly solid. High yield is a unique asset class in that it gives you both the treasury duration component and it gives you the spread, right, or the credit. So it actually is, as a standalone, an incredibly efficient asset class. Okay? Spreads can certainly widen from here, right? Like let's not kid ourselves based on where the lines in or the dots in yellow are. But what we've seen the past couple of years is any widening in that spread has been bought, right? Whether it be high yield, investment grade, just the last 3 days or 4 days of January, we've had enormous IG and high yield supply. And the market has absorbed all that paper with very little problem. So again, if we do see a spread widening, if we do see a yield back up that causes there to be a higher yield that people will buy, we think people will buy that yield.